Hey guys, today I'm going to be talking about the 7 best dividend stocks that you could buy right now in July. These are stocks that pay out a high dividend and that I've analyzed to be undervalued so that you can gain from both a high dividend yield and capital gains. So if you're a little interested in learning about these 7 specific stocks, stick with me in this video and I'll talk about them all. But first, my name is Zino Rovato and I'm building this specific channel to help you build your financial freedom. I talk regularly about stocks that are very undervalued or that have a high potential of high growth. So if you want to be aware of these specific stocks at all times, consider subscribing to this channel and hitting that bell notification so you stay notified when I upload my new videos. When I analyze these specific companies, I looked at 2 specific parts. One is a high dividend yield and 2 is that they're undervalued. And what I mean with a high dividend yield is above 4% dividend yield at least, and something that is sustainable. Second is I'm looking at the capital gains possibilities. I'm looking at companies that right now are undervalued so that if you buy them now, you can gain from both a high dividend yield and from a capital gain from the stock prices that are increasing. But most importantly, I'm also taking a look at their fundamentals. I take a look at the company specifically to see if their debt position is good, their payout ratio is good, and if their long-term prospects are also good. So that if you buy these companies for the long-term perspective, they're gonna be good companies to keep in your portfolio. So let's jump right into it. Let's go into the first company, and that's Prudential Financial Incorporated. And this is a company that is focused on investment products. They've been incorporated since 1875, so they've been in business for quite some time and have a long reputation of being solid. They have an amazing dividend yield of 7.42%, which is extremely high. And usually companies that have this kind of dividend yield are having some issues, and this company does not. And if we're looking at their long-term prospects at the same time, their dividend is growing at a massive 10% per year. So that means that 7.42% is going to be 8% in the next year, looking at the current valuation, which is a great dividend stock. And the dividend has been growing for the last 12 years, which is very good, but also if we're looking at their growth rate, they've been growing at least 14% year over year, which is very good. That means that if they keep growing up with this current rate, that's going to benefit you. Now, the fundamentals also look really well. If I'm looking at their price to earnings ratio, they're right now at 8.25. And they have a forward price to earnings ratio of 6.3. And that forward price to earnings ratio is what they're expecting to earn next year. And if I'm looking also at their price to book ratio, they're very undervalued. They're at 0.39 at this moment. A good company is under 1.5. And this basically means with the price to book ratio that you can buy their assets at a discount and their earnings at a discount. So this is, for me, a very undervalued company. And when I was looking at their debt ratios as well, they also are very well positioned for their debt. So this is overall a really good and strong, solid company for you to take a look at for your own portfolio. Now, second, we got Prudential Financial Group Incorporated. This company delivers retirement services and does investment services as well for their clients. They have a very large pool of different clients that they work with, from corporations to medium-sized companies to individuals, all together, a very well-rounded mix of customers. They have a very good dividend yield of 5.49%, which is amazing, and the dividend growth is a little bit slower at 4% for this current year. But if we take a look at the last 10 years, their dividend growth has been for 16% at least, which means that this could be just one bad year. So what I like to do is like to take a 5-year average and then average that out instead of just taking one specific year. That's why I included this one on the list. As when you take these averages, you can consider that this growth on average for the last 5 years is probably going to be the growth that you're going to have for the next 5 years. So that's why I take an average instead of just taking one bad year. Specifically, if you're investing for long term and you're specific for value, that is a great way to select these specific dividend stocks. Now, if I take a look at their fundamentals, they look actually very undervalued as well. Right now, their price to earnings ratio is 9.13, and their forward price to earnings ratio is 8.93, which is under the 15 that I'm trying to look for. And their price to book ratio is 0.87, which is a very good rate, much lower than the 1.5, so that is excellent, and that's an undervalued company for me. They have a very good growth rate as well in their revenues, And at the moment, their debt position looks amazing. So I think this is very good for long-term prospects as well. There's no risk for them really to cut their dividend in any time soon. Now, third, we got a very well-known company, International Business Machine. This is the company that provides cloud-based solutions to companies worldwide. They basically deliver the system so that most corporations can run their systems smoothly. So they're a key aspect for most of these corporations, which gives them a unique positioning. Current dividend rate is 5.45%, which is very good. But their dividend growth is only at 4%, which is lower than I usually like, but it's still above inflation. But taking a look at their growth from the last 5 years, they've been growing on average at 9%. So if taking this average of 9% from the last 5 years, their future prospects look quite good. Now, their fundamentals do look a little bit overpriced in my opinion. So this would be more of a dividend play and something that you're going for the dividend yield. Their price to earnings ratio right now is at 11.85 and a forward PE of 11.05. That is underpriced under the 15 that I'm looking for, but if you're looking at their price to book ratio, that is 5.31, which is much higher than the 1.5 that I like to have. So this is going to be more of a dividend play for you to consider. I wanted to ask you something. Have you liked this video yet? Have you subscribed yet? I need to grow this channel. I don't have a lot of subscribers, so if you help me out, I would really appreciate it. And thank you. I'm going to help you out with all the stock picks that you need. So consider subscribing again, and let's go to the next one. Franklin Resources. Now, fourth, we have another investment company, Franklin Resources. Yeah, another investment company, another one with a super creative name. You know, Franklin Resources, that one is top-notch creativity. This company does investing in mutual funds. So basically, they have a wide range of different investment products that their clients can buy from individuals to corporations. They have a very good dividend yield of 5.16%, and their dividend growth is at least 4%, which is lower than I like, but it's still above inflation. And last 5 years, the growth has been 12%. But if I'm taking a look longer back, it's been 14%. So they've been consecutively growing their dividend very high over the last 20 years. So that's something that you can keep in mind. This company right now has a lower dividend yield, but if we're taking a look at their long-term prospects, they're probably going to increase that in the future. And this company has been growing their dividends for at least 40 years. So they're considered as well a dividend aristocrat. So this is a long-term play for you to consider. Fundamentals also look very good. Their price to earnings ratio is 10.49 and their forward price to earnings ratio is 10.04. Which is very good. And if we're taking a look at their price to book ratio, they have a price to book ratio of 1.02. So overall, this is an undervalued company, which is a good play for both a dividend strategy and a value strategy. I'm going to be talking about the fifth stock, and that's Community Trust Bancorp. And this company does corporate banking and private banking, basically helping out with accounts and bank accounts, loans, all of these different things that they're doing. Now, the customers are small and medium-sized companies, and they focus more on the local community. Right now, they're located in 79 locations and primarily focus on these local communities as customers. They have a dividend yield of 4.81%. And their dividend growth is 7%, which is very good. And recently, their dividend has actually been growing faster than what they normally grow at. So this is indicating that their earnings are increasing, so that can be a good long-term play. Now, the fundamentals look okay. They have a price to earnings ratio of 9.97 currently, and their price to book ratio is 1.17. That overall looks good. Now, the one thing that is a caveat is their forward price to earnings ratio. They're at a higher rate than what I would like. That is right now at 30. The reason for this is that a lot of banks have actually had to indicate more losses to make a cushion for what's coming with the current crisis. And that's what's causing their earnings in the future to be a little bit limited. But I think this company can really weather this storm very well. If I'm looking at their debt position, they have one of the lowest debt positions of any of the banks out there. Their debt to equity ratio is basically 10% of the total equity that they have. So they have a huge cushion of what they can pick up. So I don't think they're going to be cutting dividends because of the very good balance sheet that this company has. So that is why I included it on this list specifically. And sixth, we got an oil company. This is Imperial Oil Limited, which is a Canadian company. And who doesn't love their Canadian oil? It's one of the best oils out there. So let's go over the border and let's go to Canada. You can still buy this stock on the New York Stock Exchange. I'll add the ticker right here, but this is a very good company for you to look at. Overall, this is a company that has a great position into the entire supply chain. And probably most of you don't know, this is actually a subsidiary of ExxonMobil, which is an American company. Yes, Americans own everything. Currently, their dividend yield is at 3.86, which is a little bit lower than what I would like. But the one thing that is very interesting is their dividend growth rate. They're growing at 16% from the last year. In the last 5 years, the dividend growth has been 10%. And what I'm looking at right now, I'm seeing that they're accelerating with their dividend growth. So I think this is going to be a very good dividend play. But now you're asking me, what do I think about the oil situation right now? And let me explain what my opinion is. Right now, what's happening is that all oil companies are cutting their drilling expenses and future drilling operations. And that is going to have a huge effect on the oil market in the future as supply is going to be diminished. Right now, demand is diminished, but if we're looking at the future, that is going to be a very big factor to increase the oil prices in the next year. And that is why I'm adding this company specifically. This current earnings are not going to be that good, but if you're taking a look at this for the long term, this is going to be a very good dividend play for you because you can grab it very cheaply right now, and if you hold it for long term, this dividend and the capital gains are going to be a very good play for you. Now, taking a look at their fundamentals, their price to earnings ratio right now is 13.37. They have a forward price to earnings ratio of 14.21 because of the low oil prices right now. And their price to book ratio is 0.71. So in my opinion, this company is undervalued at their current valuation. And lastly, their balance sheet, their debt position looks very good. Their payout ratio looks very good. So overall, an excellent company to look into. And I really think that this is a great company to invest in. And who doesn't want to invest in Canada? Come on, this is an oil company in Canada, owned by ExxonMobil. I think this is a great pick for you for your own portfolio. And number 7, we got one of the most exciting companies of all, and that is Pfizer. And this company is specialized in making medication for all kinds of different drugs. I'm probably known by most dads for that special blue little pill that they make. You know, that one that your dad is probably never going to tell you about. And if you still don't get it, I'll put an image right here so that you understand. So let's dive right into the details, shall we? They have a dividend yield of 4.4% and a dividend growth of 6%, which is basically good, and that's what I like to look for. Average dividend growth of 6% of the last 5 years. So that's very good and that's solid. So that's going to continuously grow at that specific rate. But there is one caveat, and that is that in 2008, when the financial crisis happened, they actually cut their dividend. So this is something that you do want to consider when investing into this company. So overall, it looks good. You need a couple things that you need to keep in mind when investing into this. So let's dive into the fundamentals. First, they have a price to earnings ratio of 12.32 and a forward price to earnings ratio of 12.2. That is overall very good. But if I take a look at their price to book ratio, their price to book ratio is 2.95, which in my opinion is overvalued for the equity that you're buying. So overall, it's a little bit overvalued company. So this is more of a dividend play. Their debt position is higher than I like, but if I'm looking at other companies in this sector, they're much lower than the average. And when I'm taking a look at their payout ratio, I see that their payout ratio is very solid. They're not in danger of risking their dividend at all. Overall, a good company, just not as good as other companies that I had on this list, but I do want to include it because sometimes it's good to diversify your portfolio because Pfizer does stay relatively stable in their valuation. But guys, did I miss any companies that you liked? Do you think my choices are absolutely nuts? Well, I am nuts, but it doesn't matter. Leave me a comment below about which companies you think were good, and I'll try to get back to them all with specific videos regarding them. Now guys, and if you want to learn more about investing, consider subscribing and smash that like button, and I'm going to be adding a few videos right here that are going to help you out with learning investing overall.